What's the most common mistake real estate investors make in December? What's the biggest write-off most W-2 earners forget? What will get investors audited instant? What is the biggest legal tax loophole real estate pros misunderstand? If someone wants to save the most on taxes with the least amount of effort, what's the one move they should make this week?
Your biggest return on hassle is definitely going to be maxing out your retirement accounts. It takes 5 minutes. It's guaranteed savings, and it's going to be the biggest dollar for dollar deduction most people can get with almost zero effort.
Investors, welcome back to the Real Estate Hacker Show. I'm your host, Dave Hathaway. It's December, and that means you have a small window to legally wipe off thousands off your tax bill before year end. Today, I'm interviewing a CPA to discuss the final write-offs you can do as an investor and whether you're a W-2 employee or real estate professional, what you must do before December 31st to be able to take advantage of the tax code. So I am joined by Colin Van Balen, CPA and owner of Windstone Financial, to break down what we need to be doing right now to, of course, have more money for investing. Welcome, Colin.
Hi, my name is Colin Van Balen. I'm a CPA and founder of Windstone Financial. We specialize in handling the day-to-day accounting, tax, and advisory work for more than 50 small businesses.
Nice. Welcome, Colin. I know you're one of our preferred vendors over at the Real Estate Hackers, and so I appreciate you for that. So, Colin, who does Windstone Financial serve, and then how can you help investors save money?
Yeah, so we primarily serve small businesses and real estate investors. Our goal is to work with you throughout the year to help with your tax planning and do all of your day-to-day accounting. And it's by doing the day-to-day accounting that we can look for ways proactively to help save you money rather than waiting to the end of the year, like what we're doing in this video, or you having to reach out to us and ask questions and do all the research yourself.
Yeah, and Colin does my personal books, so I'll give him kind of that plug there. And I've been working with you, Colin, for a while, so it's a pleasure to have you on for our viewers to be able to tap your knowledge base, because I've been tapping your knowledge base for, I don't know, 4 or 5 years at this point.
Yeah.
So thank you for that. If you don't mind sharing kind of the big difference between W-2 earners and then real estate professionals, just so our audience knows kind of what that difference is.
Sure. So the big key between the W-2 earners and real estate investors is that there are different buckets of real estate investors. So you can be a W-2 earner and a real estate investor, and all of your income and losses is still going to go into the passive bucket. If you're a W-2 earner, usually any losses you have are stuck in that passive bucket, and they can't be used to offset your W-2 income. You're able to qualify as a real estate professional, then the IRS basically flips a switch, your rentals become active, and all those active losses can offset any type of income you have. That's the whole advantage of being a real estate professional rather than just a real estate investor.
For people that aren't sure if they qualify as a real estate professional, I know there's some standards around that. What's the standard? And is there like some just hard and fast rules to know, like, hey, you're a real estate professional, or hey, you are probably not a real estate professional?
Yeah, so I mean, there's 2 tests, and the first one is you spend at least 750 hours a year doing real estate work, and the second one is it has to be more than half of the work you do. So if you're a full-time W-2 employee, it's going to be hard to claim that you're a real estate professional, because that means, yes, you're going to be working 40 hours a week, but you're working more than 40 hours a week doing your real estate professional work. So the second one is the one that usually trips people up the most.
Okay. And then, I mean, just that hard and fast rule, at least from my understanding, you can correct me if I'm wrong, is basically like, hey, if you have a big portfolio, a rental portfolio, and you don't have a job, you're going to pretty much be easily qualified as a real estate professional. But if you have that W-2 job and you have rental properties, it is much harder to qualify, because now you have to justify being working at this job as W-2 and then qualifying for your hours, instead of being like, hey, I don't have a W-2. All my hours are in real estate.
Exactly.
That's my understanding. Like, it's much easier if that's your only thing. It's much harder if you are a W-2 employee working 40 hours a week, probably almost impossible
Yep.
because then you're going to have to show that you're working 80 or 90 hours a week, and they're going to want written records and a bunch of other craziness for you to justify it, because that's how a lot of people try to get over it that way.
Exactly. And that's also why, even if you have a W-2 job that you're happy with, but you do have a player two, your spouse, who doesn't have a full-time job, a lot of times they will get them to qualify for the real estate professional status, because I think the 750 hours a year comes down to 15 hours a week. So they'll just have them help out with a lot of the rental activities. And a lot of times they end up liking doing it. And that's just an easy way for you to still be able to claim any of these paper losses against your active income.
Gotcha. And just a quick question that came to my mind right there. If your spouse doesn't work, so she's not a W-2 employee, and she gets her real estate license, she's a realtor, does she then qualify as a real estate professional?
No.
Or no, she's got to actually be active. What if she's showing properties? What if you don't own necessarily properties, but she's showing and she's active as a real estate, as a realtor?
Yeah, being a realtor doesn't automatically grant you real estate professional status. You have to be actually performing work with the real estate itself, renting out the properties, developing the properties, all that. Just buying and selling properties and showing people houses doesn't give you that status automatically.
Okay, gotcha. So you still have to either own some sort of investment property or do something along that lines, or be managed, or you're like a property manager and you're managing other people's properties. Is that right?
Exactly.
Okay. But just showing listings is not going to give you that real estate professional status, even if you do the 700 plus hours.
Yep, that's correct. It will not give you that status.
Okay, cool. Well, that answers that question for me. So let's go into, let's break it down into W-2 earners. So let's first just kind of hammer through those things of what people can do right now. It's December. It's like hot seat month. Hopefully you've already chatted. So for people looking to have process and systems involved, I think it's important to chat with your accountant or bookkeeper, if you have one, March and September. That's what I have in my calendar of those 2 months. And so if you don't, you can use my system. If you don't have one, if you don't have an accountant or a bookkeeper, you can reach out to Colin or reach out to your local, bookkeeper, accountant. I do think that's a great team player. But let's break it down for W-2 earners. Let's hit what they can actually do right now, and then we'll hit real estate professionals. But W-2 earners, what's the biggest high impact, low effort things they can do, just going right down the list?
Yeah, so if you want an easy year-end tax win, I would just start with your retirement accounts. If you have a workplace 401k, that's going to have a hard deadline. So you got to make sure all your contributions are in by December 31st. There's a lot of different strategies that we can hit for that really quickly on how to optimize these retirement contributions. First one, backdoor Roth IRA. That's what you want to use if you're a high income individual, and that's not going to save you your taxes this year. But what it's going to do is you're going to be able to contribute money to a Roth IRA that you normally wouldn't have been able to. And when you finally withdraw that money at retirement age, it won't be taxed. So that's the benefit of that. That's for a future benefit, and you can do that at any time. The other one is just the employer match. If you're not taking advantage of the employer match, you're basically ignoring free money on the sidewalk. You can also pre-fund next year's IRA immediately on January 1st. Once again, that's not going to give you a tax benefit this year, but what that's going to do is it's going to maximize the amount of time your money is in the market. And they always say that time in the market beats timing the market. If you have a side hustle, setting up a solo 401k or a SEP IRA is always a great idea, especially if it has some sort of profit flowing through. Because for a solo 401k, you might have maxed out your employee contributions, but the vast majority of employees are not getting the employer contribution maxed out. So if you have a side hustle where you're the only person in the business, you have a profit, you don't need the income to live on, and you want to lower your taxes and plan for the future, contributing all that profit into a solo 401k from the employer standpoint, from your business, is going to be a great way to help lower those taxes. And then lastly, it's Christmas season, so you might be getting an end of the year bonus, and you can, for each individual paycheck, speak with HR, log into your portals, but you can adjust the percentages that get contributed to your 401k. So if you have not maxed out your personal contributions to your 401k on that bonus, I would increase that percentage.
Gotcha. Let's talk about monetary amounts real quick for 401k. Is there a limit that individuals and married couples can contribute to their 401k, or can I contribute, 50k a year?
So the employee limit, so your personal contribution that you're deferring from your salary is $23,500. And then the employer can contribute the rest up until you do a combined at $69,000. But that is also limited to 25% of your salary. So if you're making a lot of money, this might be an issue, but for the vast majority of people, that 25% is not going to be an issue. But the max is $69,000.
Gotcha. That's for 401k?
Yes.
And for Roth, it's lower, correct?
Yeah, if you're just doing traditional IRAs, Roth IRAs, it's about $7,000.
Gotcha. That's annoying because that doesn't help me. I've never actually looked at the 401k limits because I haven't worked for an employer for a long time. So I'm always looking at just like the Roth. I'm like, man, I can't even contribute very much at all. It's 7K for married couples. Is it 7?
Don't know off the top of my head the exact amount. I want to say 7,000, but
I want to say it's 3,500 for individuals, and then 7K. It might be raised at this point, but they raise it every year, it seems like.
Kind of. It's such a small raise. So yeah, it's still $7,500 per.
Okay. And so, yeah, let's chat about HSA. Is that something that people contribute that actually lowers their taxes? And another thing that I would love for you to explain is, does it lower the amount of taxes, or is it lowering your actual salary?
So HSA 100% will lower your actual taxes, and lowering your salary just depends on who is responsible for contributing to the HSA. Because you can have an employer-sponsored health plan, but still set up your own HSA on the side if it's a high deductible health plan, which means you're paying premiums you're paying a deductible over X amount of dollars. Don't know what that is off the top of my head, but the big advantage to doing that is you're going to get something called the triple tax benefit, and it's the only account that does it. And what that means is you get a deduction going in, it grows tax-free, and you can spend it tax-free. So you can pull out all that money and spend it later in the year. And one of the best strategies for doing this is because the HSA is valuable for compounding its growth over time. You put it into an investment account, whereas money market high yield account, and you don't have to pull that money out in the year that you're claiming any of your health related expenses, like prescriptions or doctor bills or any of that. You can save all those receipts and wait 5 years in the future and just take all the money out then. That way you can spend some time with that principal growing instead of just drawing on it every year and not getting any growth.
Yeah. And what's the amounts that people can put in an HSA?
4,300 for individuals. And if you're married, it's 8,550. But an important thing to realize there is just because you're married or might have kids, might not be eligible to contribute the full married amount. You have to have your spouse and your children under your plan in order to qualify. If they have their own plan or that they're under, you're only going to be able to do the single contribution amount.
Gotcha. And you're saying if they have their own plan through work or something, that's what you're saying?
Yeah, sometimes spouses are on different health plans based on their employers. They don't transfer them over, or one just gives better benefits for the kids. So they'll have different plans. But if you're the only one who has an HSA eligible plan and the kids are on the spouse's plan just because it's easier and they have better coverage, you can only contribute the 4,300, the single amount. You can't do the married filing jointly amount.
Gotcha. Bit confusing, but I'm gonna hopefully everybody else caught that, and I'm just not smart enough.
We can run through it again, but a lot of people will split up their health insurance because if you're on a plan that qualifies for an HSA, it's more expensive if you actually need to go do doctor visits.
Yeah.
So oftentimes if a spouse also has a health plan and you got to take your kids to the doctors all the times or things like that, it's just easier to keep the kids on that plan. You'll save more money in the short term. But if you're doing that, only the person who is eligible for the HSA plan can contribute to the HSA. So that's why they only get the single contribution amount. They can't do
that. It's tough because, I mean, that's tough. If you end up doing HSAs, I have one with my wife, and it's like weird because I can't just contribute all to mine, and then we both use the same card. It's like complicated.
Yeah.
So Colin's just talking about it's complicated. I know it's complicated because I've tried to do it. I'm like, why can't I just put it all on my card and we both use the same card? But I'm sure the government has some sort of reason. Maybe they're divorced or whatever, and you got to be able to split it up. I don't know. Cool. So, and that one, just when we talk about $4,300 as a tax deduction, does that just come? So I put $4,300 in an HSA that I can spend only on health related stuff. I get that tax deduction during that year. So we're talking about 2025. Does that mean if I make $100,000 now, I only make, if I put $4,300 in the HSA, now my actual salary that's going to get taxed is 96,700.
95. So,
It just lowers just lowering your salary, so that part doesn't get taxed.
Exactly. So just a good way to estimate how much tax you're going to be saving is to just take your salary, go see what tax bracket you're in. So if you're in the 20% tax bracket or whatever, just multiply 20% by that 4,300, and that's kind of what your estimated savings would be.
Yeah. So if you're doing an HSA for 4,300, you put in 4,300 in that HSA, and you're in a 20% tax bracket, you're basically saving $860 in taxes because you're not having to pay that $860. Then you can put it in a high yield savings account, let it grow. You can use it for your health expenses. I mean, I like this one a lot. I don't think, just for other investors to know, kind of like my mindset of HSA, I originally was like, oh man, this is going to be like this investment vehicle that I'm going to be able to put in like syndications, other stuff. And it's really hard to build that amount up. It's going to take forever to build it up, to even put it in like a syndication that makes it. So I don't think of it as an investment vehicle. I just think of it as a tax saving vehicle. And I don't necessarily try to build it up and maximize it as far as like compounding interest, which you should do with your investments. I don't think of HSA as investment. I just think of it as a tax saver. So
I like to, as the tax guy, I like to think of mine a little bit as an investment vehicle, an extension of one of my IRAs. Like the emergency fund is set up where if I'm in the hospital and I need to pay big hospital bills, I'm going to the savings account before I'm going to the HSA account to pay for that. Because I want that money to compound for as long as possible, even if it's only $4,000 a year. Over time, that's going to add up a lot. Because if I make it all the way to retirement age and get to withdraw this money, I'm no longer subject to the medical rules anymore. Just pull it out like it's an IRA.
Gotcha. So okay, cool. That's the big one there that you're talking about. That's cool. I didn't actually realize. So once you get past 65 or whatever the retirement age is, if they change in the future, then your HSA just converts basically to is it a Roth IRA or like traditional IRA that you're going to pay taxes on?
Roth, you don't pay taxes on.
You pay nothing. Okay, so that is actually pretty cool. That's why it's up there ranked as one of the best strategies. Makes sense now. Would you mind sharing about tax loss harvesting? I have some questions here, but how can somebody that has, maybe they invested in a stock, it tanked? Talk to me about tax loss harvesting.
Yeah, so this is great, especially if you are a real estate investor too, and you sold a property for a big gain throughout the year. So basically what this is it's looking through your brokerage, crypto, whatever portfolios, and seeing if you have anything that has gone down since you bought it. And if you do have something like that, the goal is to sell it in order to offset as much of that gain as possible. But the big thing to worry about here is you can't rebuy that stock that you owned for another 30 days. So most of the time that's fine. Most stocks aren't that volatile where you're going to lose a lot of money in that 30-day window. But if it's something like Bitcoin, where you bought Bitcoin earlier in the year for 120K, now it's worth 80 or 90K, you are putting yourself at risk of potentially missing out on a lot of those gains because it's so volatile. But tax loss harvesting is great. It works, especially at the end of the year if a stock takes a nosedive. But the big key to remember is that you have to wait 30 days to rebuy that specific stock. You can buy something else immediately, it doesn't matter. But if you want to rebuy that stock, you have to wait 30 days.
Yeah, that makes sense. My question to you, and we're talking about W-2 people, and maybe this is a good time to chat through passive income, portfolio income, and active income. Active income is your W-2 income. Portfolio income, this falls under portfolio income. Am I right about that?
Yes, but you do get to offset every year. If you do a lot of tax loss harvesting where you end up recognizing more losses than gains, you can still offset $3,000 of a loss against your active income from this portfolio income.
That's so you knew where I was going with that. I had a question of that because I just did this. And even though I did it in preparing for this interview, I was like, I probably have no idea how this works. I just hear tax loss harvest. That's why these interviews are great. I was like, I probably am doing this completely wrong and completely butchering it, and I'm not actually getting the benefit. But you're saying, and so just to bring it back so it makes it valuable so people can understand. So different income is classified under different things. And normally you got to keep that income. If you get a gain, it stays in that. You got and I set them out: portfolio, passive, active. And so your active income kind of stays over here. And even if you have you shouldn't have a loss of your active. I mean, I hope you don't have a loss of active income. But normally you can't take this income that you take a big loss in and then offset and this is what stinks about being a W-2 employee. Your like other income is just stuck over here. Yep. And any losses offset gains, but over in the passive side or the portfolio side. But what you're saying is that doesn't account for the first $3,000 of losses of portfolio income can trickle in to your active income and lower your salary, let's say $100,000 down to now $97,000.
Yeah. And if you had a massive loss that year, you still can only do $3,000. Doesn't matter what your income is, and that will carry over indefinitely forever. Which brings up the other side of tax loss harvesting is if you do have a massive loss, like something went to zero and you had a lot of money in it, instead of waiting 10, 20 years to recognize all of this $3,000 every single year, you can do something called resetting your basis. That's where you sell some of your winners to offset that loss immediately and get a higher basis in the stock when you rebuy it, if you're going to rebuy it. That way, next time you sell it in the future, you're going to be hit with a smaller capital gain.
Makes sense. So you might take that $3,000 loss, but let's say you have another $50,000 because you lost $53,000, and then you have you won an NVIDIA with $50,000 gain, and you're like, hey, I want to take this gain now. They'll offset each other because they're both in that portfolio bucket.
Yep.
And then when I go to sell this 10 years down the road, my basis is much higher, so I don't have to pay that capital gains then.
Exactly.
Just trying to give people an actual. I always find I struggle with non-real life examples, so I'm just trying to give you guys a real life example, so you go, oh, that makes sense.
Yeah, that's the perfect example. Especially,
let's chat about paying your kids. I hear a lot of this, a lot of whatever real estate investors, business owners. Hey, I'm gonna pay my kids, and I'm gonna give them $20K for cleaning cars for churro. Can you pay your kids for stuff as a W-2, or is this more like a business owner?
If you're a W-2 employee, you definitely cannot pay your kid to do your W-2 job for you.
Yeah.
That definitely is going to violate the employment agreement to farm out your job to your kids. But if you do own some rental properties, or you do have a side hustle, or you do have a business, paying family members, totally legitimate tax strategy, but you do have to do it the right way. So they have to do real tasks that if they're a kid that they would be capable of doing. You can't have a 4-year-old doing the accounting work. No one's going to buy that.
He's going to do my QuickBooks. He's going to do my QuickBooks. My 4-year-old. He's in there.
I hope not. Then I'll be out of the job. But yeah, if they're doing like an 8-year-old doing some cleaning work, you can absolutely pay them for that, but it has to be the fair market value, what you would have paid someone else to clean up the property. And you have to document it. You have to have like a spreadsheet of the hours they worked and what they did to be able to provide the IRS if you ever get audited.
Just a quick invoice that if you email Colin, he'll send you a template invoice.
Exactly. And I also have a template of with step-by-step instructions, because the more important one necessarily than the work logs, that's very easy to do, but is the fair market value of services. So you're not paying $200 an hour to your kid to mop the floors. You just kind of look up cleaners in my area and you get a general idea of the cost, grab some screenshots and throw it in the spreadsheet, and then you're covered.
No, I love that. And we chatted about this earlier because I like giving real life examples, because I hear people doing this and I'm like, I don't even know how that like looks in my business. I didn't pay my kids for it. And it's not that I did document anywhere, but just because I want my kids to understand what I do as a real estate investor, I took them both over, my 4-year-old and my 9-year-old, over to one of the properties that we were about to sell. And so we were staging and just doing a final look over, and they cleaned up, and they cleaned up for probably 2 hours before I lost my youngest to playing with Legos on the floor, because he was actually distracting my oldest. And I was like, hey dude, just play Legos.
He made is not deductible. That's not cleaning time.
And so you're saying that, labor laws don't apply here? Like you can have like a 5-year-old, like
as
long as they're like physically able, like because they're a family member, labor laws just don't apply?
To an extent, it has to be something that they are actually like qualified to do, and you have to own like 100% of the business in order for it to apply. You can't be like a passive investor or own 20% and have your kid go shovel rocks outside. That's no go. But
this could be kids shovel. If you got a bunch of rental properties and you live close by, this could be your kids going to shovel the snow for the rental properties. Completely acceptable. Completely. I pay for that out of my pocket to contractors, but they get money, and it's a win.
Yeah, you get to supervise them. And the big reason people aren't aware, like, why would we want to be paying our kids? I'm just going to give them money anyway. It's just because you're shifting that income that is in theory in a higher tax bracket to their basically 0% tax bracket. But something that people always forget about when it's time to do their taxes for their kids, and they go, wait a second, I thought I didn't have to pay any taxes because of the standard deduction. All that income that's getting paid to the kid is technically going to be self-employment income if they're 1099. So they're going to have to pay taxes to like the FICA, Medicare, Social Security still, even if it's below their standard deduction amount. And people always miss that, end up owing like almost $1,000-ish, and they're like, why? I shouldn't have done that. So stupid. So just keep that in mind if it's going to actually save you the money.
Gotcha. So you're saying you're reporting 1099s. You have to report 1099s. I think that the number is like over $500. You pay somebody, you have it's
600,
something like that. And so if you're paying your children over $500 per that tax year, and we're talking about 2025, then you're going to have to pay self-employment or like FICA and this other stuff.
Yeah. So if you're paying them $1,000, it's only going to be like $77 of taxes. But if you're trying to max out their standard deduction and you're paying them like $10,000, then that's going to be $760 of taxes.
Okay, cool. Yeah, it's a good thing to note. It's good information there. When I was doing a little bit of research, do you know what the Augusta Rule is? And can you kind of share it? What that is, how W-2ers can use it?
So the Augusta Rule is basically where you can rent out your primary residence for up to 2 weeks throughout the entire year, and you don't have to report that as income. And it's called the Augusta Rule just because everyone who's lucky enough to own a property on Augusta where the Masters is played rents out their property for that week, and they make a lot of money doing that, and they don't have to report any of it as income.
Cool.
But the strategy doing it is, if you're going on vacation, you can put your home on Airbnb for 2 weeks. If you have a business, sometimes you rent out your property to your business and you invite all your employees to come in and stay and use that as kind of the rental property instead of booking hotels. And that just shifts an expense into the business where you didn't actually lose any money because you're just paying yourself. But the big key here is, once again, it's going to be documentation, and it's going to be the fair market value for actually staying there. So similar to with the kids, where you went online and you found what you would pay for the similar job, you go online, you look at hotel costs, Airbnb costs, and you have to take for that date range, like the same price that everyone else is charging. If someone's charging $100 a night for the same property, you can't charge $1,000.
Yeah, that makes sense. And you guys can dig into that if you want, but we just are going to surface touch that one because I'm sure we can go a bit deeper on that, but Colin hit it pretty good. So thank you. Charitable contributions. And the thing I want you to hit here with charitable contributions is I'll share with people what I do. And then you can kind of correct and say, hey, you're an idiot, Dave. You should be doing this. We don't get receipts from anything. We actually donate a decent amount, but I know that donation is not going to be close to my standard deduction. The standard deduction for me, Colin, is what with 2 kids, married and 2 kids, off the top of your head?
Close to $30,000 in 2025, I believe.
Okay, so 30. So I'd have to have charitable donations of over $30,000 for it to even matter for me.
Not necessarily.
Not necessarily. Okay, so I'm wrong. So go ahead. But this is the reason I'm not even close to a $30,000 insure. I mean, yeah, I'm not close to $30,000 in like donating clothes and donating stuff to these big green boxes that you see around. I'm always getting rid of clothes. Like, oh man, let's get rid of this stuff. I love downsizing in the house. It's like my pastime. But I don't document any of that stuff because I know it's going to take forever to reach the threshold. Should I be documenting that stuff or should I not be documenting that stuff? And talk to me about that standard deduction for most people and when they should start documenting when they're doing charity.
Yeah, so with the new big beautiful bill that was passed this year, it expands this opportunity to take these charitable contributions a little bit more, because originally for the past couple of years, you only wanted to really be documenting all these charitable contributions, still contribute to charity, but you didn't really need to pay attention to how much you actually did. Was only if you were paying property taxes and paying mortgage interest. So those were the 2 ways that we're going to get you to itemize your taxes. Now that the SALT cap is boosted, $20K for single and up to $40K for married filing jointly. Now that that's boosted, and if you live in a state that charges income tax or withholds income tax, you can deduct that now up to that $20K. And if you're single and you're high income, you're going to be able to surpass your standard deduction easy. Same thing if you have a house with property taxes and a W-2 job that's in a place that charges state income tax. You're going to be able to pass your standard deduction much easier than you have in the past, which makes the charitable contributions more relevant of just documenting them. Grab the receipts. If you are donating clothes, thankfully in the age of AI, it does make it a little bit easier if you're just donating stuff, because you're not always going to get a value receipt from Goodwill. You'll just have to make an itemized list of what you donated, the condition, and instead of typing in everything and searching for every little thing you donated, you could put it in an AI and it will give you some reasonable estimates of the fair market value of the stuff you gave. You gave a shirt with a bunch of holes, worthless. You gave a refrigerator that works, that could be a couple $100.
Gotcha. Makes sense. So what's our hard and fast rule here for documentation? When should you document if you have? And I don't totally know what the SALT stuff is, the SALT cap that you kind of hit.
So if you have
like, hey, if
you have property taxes and a mortgage, 100% keep track of all your charitable contributions. Make a receipt folder in your inbox and just put it in there and revisit it later during tax time. If you live in a state that has state income tax, And when you look at your pay stub, you can see the amount on there. And if it's going to be like 20K to 40K is the range, but if it's a high amount and you are also paying property taxes and home mortgage interest, save all those charitable contribution receipts.
Okay. And the thing is, if your property taxes and your mortgage interest go over that standard deduction, then it's like everything's in the green and you can write everything off. So
Exactly.
if I have property taxes and I'm trying to think about me right now. When I got property taxes and mortgage insurance, and let's say it is $25,000, then if I donate to charity over $5,000, everything that I donate over that $5,000 is then going to be correct.
Yeah, assuming that's the standard deduction amount, yes.
Okay.
But, it's still important to remember that you're still spending $1 to save like 25 cents. You're still not getting a dollar for dollar reduction on the charitable contributions.
Okay.
You're still getting more money than what you're saving. But even you don't have a standard W-2 job, real estate investor. But if you did happen to pay taxes in your state for last year's tax return, you would have paid that this year. That is still deductible. So you can add that amount that you paid for your taxes to the state you're living in on top of your property taxes and mortgage interest to see if you cross that threshold.
Yeah, and that includes the property taxes you pay. Does that also include like how much you pay your accountant or your bookkeeper to prepare those taxes for W-2?
I mean, that would be if it's like the business return, then you could be putting that through the business as a deduction.
But if you're a W-2 and you don't have a business, no deduction there?
Nope.
Man. Okay. All right. Okay. Makes sense. I'm following. Hopefully you guys are getting some value from this. House related deductions, points on mortgages, talk about property taxes. I mean, you didn't talk about like if you do a refi, is that included? Those, the points that you're paying down in as same thing as mortgage interest?
Yeah. So, I mean, if you bought a home or you refinanced that home this year and you paid all those points and closing costs, all that stuff is deductible up front. Mortgage interest in general is only deductible in the year that applies to the interest. So you can't go randomly and just prepay a bunch of mortgage interest and expect a deduction. But when you buy the home and you refinance the home and you paid points at closing for that, that is deductible.
Gotcha. The last thing I want to hit for like W-2 employees, if they wanted to like capture some of these extra deductions with some sort of like side hustle to create like a business, maybe they can't qualify for real estate professional status. What kind of side hustles can they create? Can they do like driving for Uber? Is that not? I mean, is that just that's probably just another 1099 to be honest with you.
1099s are side hustles. 1099s, all that income, you can put it onto the Schedule C tax form, not important, but that enables you to start taking deductions. So all the money you're getting from Uber, then you're able to deduct gas that you're paying for, repairs that you're paying for, the water bottles you put in the car for the people, maybe some meals if you went way the hell far away for the travel, the auto insurance, the depreciation. So even something as simple as door dashing and Ubering can open that deduction. The big thing to keep in mind if you're looking for a side hustle just to help unlock some tax benefits is you need to generate at least some revenue, and then eventually you need to turn a profit. Because if you do 5 years of the same side hustle, like you're a woodworker and you're doing it just so you can pass all these losses through and you haven't turned a profit once in the last 3 to 5 years, the IRS has the ability to go, no, this is not a business, this is a hobby. So all those expenses aren't deductible anymore.
Gotcha. And then when you have those deductions, when you do something like that, like a 1099 or create your own LLC that you're consulting or doing something like that, then is there anything that we need to know about as investors or just trying to save money on taxes? Can you then have like a home office and write that off? Or
yeah, so you can do a home office, but as long as it is not a room also being used for something else, like your home office can't be a desk in the corner of your bedroom or the living room table. It has to be a dedicated space to be able to deduct it. And you can only do either $5 per square foot up to 300 square feet. So it's only a $1,500 deduction. Or the annoying route that's more lucrative, but also going to cause you headaches down the line is you can claim like the active method, which allows you to basically depreciate the office in your home. And when you sell your home in the future, they're going to try to recapture that depreciation you claimed, which is why it's annoying. But at the time, it's nice because it'll be like, wow, I got to deduct $4,000 because of my home office. Yay. But in reality, it's going to get clawed back in the future.
Was there anything that we missed there for W-2s that's like low hanging fruit that people can write off to save in taxes?
Yeah, I mean, now you got your accountant fees, yay. Mileage, so if you have to drive to go get supplies, drive to go meet a client, drive to go ship something, you could get free apps where you can download and just either type in where you went, when you went, or just have it record it. And you can deduct all that. I think it's up to 70 cents per mile now. So it's
And that shipping, what are we talking about for shipping if they are W-2? Is that?
Well, for side hustles, like maybe they're like making stuff and selling it on Etsy. You gotta go to the
Gotcha. Okay.
Yeah.
Yeah. I mean, I use Mileage IQ. And so I think that's an awesome thing. It just works in the background of my phone. If you're a conspiracy theorist, probably not the best app for you. But for me, hey, whatever is going to make it easier for me. My life's hard enough.
That one's great for me because I have a horrible sense of direction. So if I am going from point A to point B, odds are I will get lost. And if I just plug that into a spreadsheet, I'm missing out on valuable mileage that I could be deducting by getting lost.
Yeah. There's some really great apps there. Before we go on to end of the year moves for real estate professionals and just hit all the real estate professional stuff, I want to do a quick plug for my Master of the Rehab class. Check it here.
Are you thinking about investing in real estate, or maybe you're investing in real estate already and you want to build your rental portfolio, but you're struggling a bit with renovations and rehabs? Maybe you're paying too much for repairs. Maybe you're working with bad contractors that aren't calling you back, or they're ghosting you. Maybe you're going way over timeline or over budget on your rehab. If any of this sounds like you, or you're just lacking confidence in your systems in how you renovate a property, I've created a course for you. My name is Dave Hathaway. I built a 50-unit cash flowing rental portfolio, and in doing so, I've developed some proven systems. I share how you can determine how much the rehab is going to cost, and I also share how you can find the best contractors. So if you are lacking the confidence or systems in having a great renovation every single time, this course is for you. Check it out. Go to masterrehab.com or go to the link in the video description, and I'll see you there.
Hey, we're back. We're going to chat about end of the year moves for real estate investors that qualify as real estate professionals. And this is where we can kind of really dive in. Colin, would you mind discussing what is a cost segregation and how can like investors use bonus depreciation?
Sure. Yeah. So normally with your rental property, you're allowed to depreciate it over 27-ish years. And all that means is like whatever you paid for the property, you get to deduct that amount, but over 27 years. So it's not super meaningful most of the time.
Yeah.
What a cost segregation study will allow you to do is it will take different components of the property, like the roof, flooring, the appliances, HVAC, electrical, and it will depreciate it over a shorter timeline. So it'll move stuff that will take 27 years to recoup the cost for. You can do that in 5 years or 10 years instead. So it basically just accelerates how much depreciation you could take up front. And that's super valuable for the real estate investors, just because you're going to you might have purchased the property with a loan. You didn't expend any of this cash yet, and you're getting a deduction now on your taxes for it.
Yeah, makes sense. And then when is it worth doing a cost segregation? Like, can somebody do it here in December now? If that, let's say they just purchased a big
So that's actually the thing a lot of people don't fully understand is you could do the cost segregation whenever you want. So like Dave, if you bought a property in 2020 and you never did a cost segregation on it, you can do that right now in 2025, and it will catch up all of those 5 years of the accelerated depreciation that you missed, and you can do it in this tax year.
Sweet.
And that's you can also, you don't have to do it within this tax year either. We could do it in 2026, as long as we do it before we file, we can still recognize it in 2025. So it doesn't really matter when you do it. But yeah, super beneficial.
Yeah, that's really cool.
I have a big tax liability. I need to offset
So
this.
that one you don't have to do in the tax year. You can technically do it after, as long as before you file.
Yep.
Even if you're filing like extensions and stuff. Like, let's say you're like, hey, okay, yeah, that's huge. I didn't actually realize that.
There's a
And
lot
then,
of stress for people.
yeah, I mean, the question that I wanted to ask here was, when do you recommend like a cost segregation on a property? When is it worth it? If you have a property that you purchased for $100,000 and a lot of these cost segs, I'm just going to throw out a number because I don't know what the average cost seg is, but I would assume it's somewhere like $1,000, $1,500. I would assume that's probably on the low end and probably for smaller properties. But what is the purchase price or the value of the property that you'd say, hey, let's do a cost seg?
So when you purchase a property, so we're going to have these different components. And let's say it has all of the appliances in there and they're like relatively new, but the property value itself was low. In that scenario, I would definitely do a cost segregation, just because you're not going to have recognized any depreciation on any of these components yet. And even if the property is $50,000, but there's $5,000 of equipment in there, we're going to be able to deduct all $5,000 of that in year one. But it also matters what tax bracket you're in. If you're paying $2,000 to save or to get a $5,000 deduction, it's not going to be worth it. But if you're paying $2,000 to get a $20,000, $30,000, $40,000 deduction, as the property moves up in value, 100% worth it. One thing that I did recently to test out how accurate it was we did a walkthrough of a property and filmed everything as much as we could. We gave a prompt to an AI called Manus, which is pretty good. Dumped the video in there, asked it to identify all the components, estimate the depreciation. And that way we didn't use this as our cost seg, but it was, okay, is it going to be worth it in year one to even pay someone to do this, or is it a waste of time and money? So I'd recommend spending the 5 minutes, walk around the property, film everything, dump it in, see what it says to know, will it be valuable? Because it's such a nuanced answer of how much should the property be worth before I do it? Well, it depends on what the rest of your income is, what's actually in the property. Is it just a bare warehouse with nothing in it, or is it a fully furnished home?
Yeah. So you're saying if you have, let's give numbers. Let's say if you have, let's say the purchase price of a property is $150,000.
Okay.
And let's say there's a bunch of appliances, there's HVAC, let's say there's $20,000 of mechanicals and appliances. You're saying at that point, you would recommend somebody to do the cost seg on their property to get that $20,000 year one depreciation, especially if they are paying, let's say 20% on that $20,000, which is $4,000.
Yep.
And you would say the trade-off of doing like a $1,500 cost segregation is worth that $4,000 savings. So like a $2,500.
And there's also going to be other items in there that are going to get moved into the 15-year property probably as well, just to accelerate that. So every year you're still going to be getting the leftover effects of this benefit too. But yeah, the year one, it's a no-brainer if you are going to save more on taxes than if you would from the cost seg itself, or paying for the cost seg itself. And the cost seg is also tax deductible. So if you're in the 20% tax bracket and you paid $2,000, well, technically it was like $1,600 if you want to do that type of math as well. But yeah, I would definitely do a cost seg in that situation.
Okay, that makes sense. And you're saying to do that because not only you're saving money, but then it's extra money that you can then reinvest back into the business or in another investment that can compound. And that's your theory there, your philosophy.
And something that's super important that I've seen people mess up is they'll do cost segs on these properties, but they're not real estate professionals. So they'll have $100,000 of losses in year one, or not that crazy, but a lot of losses in year one that they're trying to offset against their active income because they saw somewhere on the internet they could do that, but they're limited to how many losses they can take from their rental properties. Especially if you make a lot of money, you can't deduct any of your losses against your active income. Make a little bit of W-2 income, you're limited to like $10,000 to $25,000 of these losses. And so if you are not a real estate professional, a cost seg, I don't recommend it unless you have a lot of other rental real estate income that you're trying to offset.
Gotcha. Makes sense. So W-2, don't listen to that cost seg. It doesn't help you. For the W-2, we didn't actually chat about like short-term rentals and that whole how W-2 employees can actually get that if they purchase a short-term rental, they can technically qualify if they're participating in their short-term rental, and then they can do a cost seg, and then they can deduct. And that is a strategy a lot of high-income earners have been using. Thus, I feel creating a bubble in the short-term rental space, at least in my eyes, where I'm like, man, these are like really hard to make money. But I think that trend, if you haven't heard that, you can look it up on the internet and go in because it's kind of deep and there's a lot of nuances there. You don't want to mess that up if you're doing that. And you have to be participating in that short-term rental. You can't just purchase a short-term rental but that is a strategy for W-2ers, not real estate professionals, because you could just automatically cost seg a short-term rental. It's the same thing as an investment property.
Yeah. Another way to try to unlock some losses, it doesn't help you with the depreciation aspect, but it can help with some of the other expenses. And that's going to be creating a not holding company, like a property management company that manages all of your rental properties. So that way you can like centralize all of the expenses and bookkeeping and everything, make that a lot smoother. And then the LLCs that hold your rental properties pay a monthly management fee to you every single month, or they reimburse the expenses as well every single month or once a quarter. And that way you can push a lot of the expenses and income back into the active bucket. So that way you can actually deduct losses that might be flowing through.
Yeah.
Active income against active income.
Yeah, that makes a lot of sense, especially if you're self-managing stuff. I mean, it's only if you're self-managing stuff, really. I mean, if you're hiring a third-party property management, I don't think that totally is above board. But if you're self-managing your stuff and it works. That's in essence what we do. For repairs versus improvements, is there anything particular here that like investors need to know in December that can maybe maximize their tax losses?
Yeah. So there's a general rule of thumb, because it's always difficult to determine, is this a repair or is this an improvement? I can't really tell. The first thing that you should be doing is the invoice that I'm paying below $2,500? If it is, just go ahead and expense it immediately. It'll be fine. The other thing to keep in mind is, this is why it's also important to consult the tax person, is if some of these invoices are for like appliances and brand new water heater, all of that can be deducted immediately, oftentimes with the bonus depreciation. So that can also be expensed. But if it's stuff to like get a brand new roof, get a brand new flooring to extend the life of the property, that stuff is going to be classified as an improvement, and that's just going to be added onto the basis of the property and depreciated over time.
Gotcha. The big ones there, that feedback for you for appliances, that's huge right off. So if you're getting new appliances, get them before December 31st. I would assume you have to purchase them in this tax year to write them off. The other big one I would assume in that category is HVAC. If you're getting a new like HVAC, a lot of times that's $5,500 to $9,000 year one deduction. That's pretty huge. So if you're thinking about replacing and you need a loss and you're going to replace that in the next 6 months, just do it early. I love that. That's what you're saying, right?
Yep. And just because another thing to keep in mind is for stuff like this, it's not the same as like prepaying for a software expense. For equipment like this, it has to be placed into service, which means it has to be installed and ready to use. Otherwise, they're going to push it to the next year. It's a little bit technical, but if they do come looking to see if you just prepaid expenses that you didn't actually use, keep that one in mind.
Gotcha. Anything else? Mileage, travel, auto deductions. We can talk about cars. Can we write off vehicles as a real estate professional? I know we can write off mileage going to driving, to and from properties, whatever you're doing. You're doing research on markets, doing travel. Walk me through those deductions real quick, and then walk me through car write-offs. Can we write off an entire vehicle? And does it have to be a certain weight? Does it not have to be a certain weight? Walk me through those things.
Yeah, so mileage is pretty easy. I think we touched it a little bit. If you are driving for business purpose, going to do some showings, inspections, meeting contractors, getting materials, whatever, all that is deductible round trip. I recommend using an app. You can also use a spreadsheet as a mileage log. You can deduct that. It's 70 cents per mile. and that is designed to pay for like your repairs and gas and insurance and all those costs. So it does feel like a good deal at the time. When buying a vehicle, to try to deduct that for like the depreciation purposes, you have to be using it more than 50% of the time in the business in order to actually be able to start taking depreciation on it. And if you're only using it 60% of the time in business, only 60% of the value can be deducted. And the other ones that make people do this all the time is the combination of vehicles depreciation, bonus depreciation, and something called Section 179. And that's where you'll see people buying Mercedes G-Wagons that are over 6,000 pounds and trying to deduct those as a business use vehicle. I wouldn't recommend going that route because those people will probably get audited eventually because you don't need a G-Wagon for your consulting business. But if it's over 6,000 pounds, almost every time you will be able to deduct the entire cost of the vehicle in year one, which is why people do this. And if it's under 6,000 pounds, you're limited somewhere between like $20,000 and $30,000. Don't know the exact number, but that's the most you can do in year one.
I mean, a lot of electric vehicles now are pretty stinking heavy. I don't know. I haven't looked at like weights, so I don't know. But when you say that, and I was thinking about it, and I was like, man, I get taxed extra for my Chevy Bolt EV because it's freaking heavy. And that's what I hear this. I didn't actually look up the numbers and how much heavier they are than regular vehicles and their extra wear and tear on the road.
I didn't realize they were heavier.
Yeah, I'm wondering if like, a Tesla Model Y or something fits in that category and is over 6,000 pounds.
I know the Tesla Model Y qualifies. I looked into it for a client a while back. It's very easy to Google, and the key term is gross like vehicle weight, like GVWR.
Oh, yeah.
And that is not like just the dry weight of the vehicle. That is the weight of the vehicle with like all the fluids and everything on it. So that's the one you want to use, because even if a car weighs 5,800 pounds, this usually puts it over 6,000 pounds.
Yeah, and the cool thing with that, as a real estate professional, and if you're used to leverage, you can purchase that car. I always find it cool. You can purchase that, and you're saying that the Model Y does qualify, right?
Yep.
So if you purchase that Model Y, but you finance it, you're still writing off the purchase. So if I purchase a Model Y, and I don't know what the purchase, but they're like $39,000, $40,000, I get that full write-off year one, goes against my income. So $40,000. If I make $100,000, now I make $60,000. But if I finance it, maybe I only put $5,000 down, and then I'm making monthly payments, I still get to write off that $40,000 down, even though I only put $5,000.
Exactly.
So we're using leverage almost in a different way here, where we use leverage in real estate investing, but now we're using it as like leveraging the tax code. And
if you want to go further,
you're also writing off the interest, right? For whatever that financing is. So if you're paying interest, you get to write that off every year. And so
yeah, if you can legitimately get a vehicle like that for your business, and you get something like a Tesla Model Y, which I'm pretty sure has great resale value after 3 years, you could kind of churn through this every 3 years and not lose your shirt on new vehicles, because you're getting all of that up front, depreciation recognized, and you're able to sell it for a similar cost to what you purchased it for.
Yeah, we're not advising of, purchasing and selling cars or how that works in your business, but make it work for you. That is just another, what I always like to say is another tool in your tool belt. Like, hey, if you're thinking about purchasing a car, you're going to purchase a car, in February of next year, but you have like $100,000 gain. You're like, man, I really don't want to pay, you're paying 20, if you're in a 20% tax bracket, paying 20,000, but that 40,000 is an $8,000 tax hit at a 20% tax bracket. And so you're like, hey, I would rather not pay that $8,000. I'd rather use my $5,000 down payment.
Yep.
And so it's you're coming out with $3,000 positive. You are going to do it next year anyways. So that's why we're discussing these strategies of like, hey, make it work for you. If you need it, that probably talks about why you kind of need to be prepared. I didn't have this templated out on our interview, but I think this is a good spot for it. As a real estate professional, is there kind of, how should people be keeping track of their taxes through the year to know if they're going to come out with the $100,000 gain? This is one of the reasons why I say, like, have that conversation in September with your account. This is why it's part of my process. This is a question that I ask, like, how are we looking? Like, you see my QuickBooks. What should that look like for a real estate professional? Should that be an Excel spreadsheet that they have their expenses, assets? What does that look like?
Yeah. So, I mean, first off, yeah, definitely the bookkeeping. Got to have a good idea of what your income and expenses are for the year. That's a given. But what people should be doing that most are not is you should be asking your tax preparer, what is my basis in this property? And they will be like, oh, okay, it's this. It's on the tax return, but it's tricky to find a lot of times. And depending on the tax return they give you, it won't show. So ask what your basis is in the building. Then you can also ask, how much depreciation are we going to recognize on this next year? Then they'll tell you. How much depreciation have we recognized over the life of this property? Then they will tell you. So the reason why the first one is important is just to know how much you paid for the property if you ever want to calculate your capital gain on it. The second one is important because then you can finally add that depreciation line item and not guess into your income and expenses that you've been tracking diligently throughout the year to give you an idea of what your taxable income from these rental properties looks like. And the third one is important because if you sell your property for exactly the same amount that you purchased it for, all of that depreciation that you've taken is still going to be taxable. And it's going to be taxable up to 25%. But if you receive the deduction for depreciation on any rental property that you sell, that part is still going to be taxable, even if you sold it for the exact amount. No gain, no loss. That's still going to be taxable. And that's something people overlook all the time.
This is why it's important to have a professional, because I, as much as I know, I know that I don't know that all the complexities of taxes. And so I'm always talking to somebody like Colin or somebody else that's super experienced in the field to say, like, hey, what does this mean? And so I like that you're telling people, like, hey, in that September call, ask your basis. That's one of your questions. Like, give me a list of all my properties. What are the bases of my properties? And it's nice to have that. And then you can kind of plan. I think it's relatively diligent to know what your bases are and then plan on, hey, maybe I'm going to sell this property instead of that property. Exactly. If you're having start of the year or next year planning, you might switch around and go, you know what, I'm going to actually hold on to this one because I'm going to have to play a massive tax hit. I don't have anything to offset that. So it allows you to kind of work through that in your mind with your accountant, with yourself, to kind of plan. Maybe you got to pair that with a big purchase to offset it as almost like a lazy 1031. We won't talk about that in here. But anything else that we need to chat about here as far as like write-offs? In front of me, I have like education and professional development. If somebody's getting coaching, they can write that off. If somebody's purchasing a course, they can write that off.
Traveling, that's all. You can write all that off. If you're traveling for the conference too, you can all write off. I actually want to bring up something that you shouldn't be writing off that people try to do. And that's the idea of putting your whole family on the board of directors and taking a vacation and having a meeting and then deducting the whole trip just because they had a meeting. The courts over and over again say you cannot do that. You could deduct part of it, maybe. You could deduct where you had the meeting, maybe. But just because you want to go on vacation and want to save money by putting everyone on the board does not work. They will come for you.
Are you speaking directly to me?
I'm speaking directly to every single person who has a board.
So I think it's good to chat here, like conferences. Like if you are thinking about going to a conference, whatever, it's a multifamily conference, if it's whatever conference it is about real estate or investing, book your flight, purchase the ticket. Write it off this year if you need that write-off. I know one thing. So I booked a trip for one of the investments that I invest in, and it was in Nashville, North Carolina, and we stayed in the Omni, and it was really great. But that was a whole family trip. But that was the real estate event was designed for the whole family. It was actually a family building event for the real estate investors, which is really cool. So I actually put everything on there, and
Yeah.
I think that's legit because it was actually a family. It was basically teaching your family about investing, and so they went over all their stuff, and you're staying in the hotel that they're providing. So I think that is legitimate, which is when you're talking about like,
Yes.
dang, is Colin trying to tell me like under the table, hey, I am writing off bad stuff? But
I
I
mean,
think that's all legit. I
there is
think
also
all
a
my
legitimate way of scheduling your travel to be able to maximize vacation time. And that's kind of having business on Friday and having business on Monday, because that means you are stuck there. So Saturday and Sunday hotel is still deductible.
Yeah, no, it makes sense. And again, if you're unsure, reach out to Colin, reach out to your CPA, your accountant, your professional, and say, hey, is this deductible or not? The goal of this video is just to, hey, what are the final deductions that we can take in December to lower that tax if we can. The last thing I wanted to just chat about is entity structuring. Let's say we have Dave, the buy and holder, or Dave, the flipper. And maybe I want to change my structuring, my business structuring. For me, I'm gonna. You tell me if I'm wrong, because hey, I'm wrong very often. And so just correct me. I'm okay. If I'm a flipper, I'm thinking S corp is probably your best business strategy. And if it's not necessarily your best strategy as a buy and holder, maybe it is. I'm personally have LLCs for a simplified structure. But let's say I want to do this. Is that right? First of all,
Yeah.
would you say
Yeah.
like, hey,
Yeah, because flipping is not, even though it's real estate related, it's not passive in the same way that like a rental real estate is. So yeah.
no, it's not. You're doing a lot of short-term stuff. So cool. And there's nuances there. So chat if you need to chat with Colin or put your comments in the video. Hey, what should my structure be with this? What do you recommend? Obviously, you want to consult an attorney on that one. So don't just take our word for it.
Yeah,
Do get professional advice there.
never own the rental real estate if you're not like doing short-term flips. If you're just renting out for the long-term, short-term rentals, whatever, don't put it in an S corp, because it makes it really hard to get that out of the S corp or transfer ownership without triggering taxes. And also, you will trigger taxes if you are doing things like cost segregations, because if you're pulling money out of that business, technically that's going to be a taxable distribution because you don't have a basis, which we go over a different time. But just know, don't hold your rental real estate in an S corp. It will cause you tax problems and headaches down the line.
Yeah, no, thank you for sharing that. Where I was going with that, if you want to create a business here, if you're like, hey, I need to create this S corp, I need to do this, those are also write-offable expenses.
Yep.
It probably also applies for a W-2, or hey, you want to create that, you want to create an entity that you're going to start working in. This is the time to do it. Do it in December. Do all your write-offs. If you are, and this is a funny one, I don't know if you saw this one on my list. If you have a huge mess for bookkeeping, I know Colin loves those people. I would assume I would hate somebody had like a huge mess. But I mean, this is like, hey, you need to have like pretty good bookkeeping if you're going to scale your operations, or else it's going to be really tough. You're going to create a lot of stress and agony if you have any lawsuits or anything like that. But if you need bookkeeping cleanupping, you need to get your stuff in order, you need a bookkeeper to come in. Is this the time to like, hey, I need a write-off. Let's get that taken care of now. Could they like technically like prepay for like a bookkeeping cleanup?
Absolutely. So you definitely prepay is an okay strategy, because you're not like reducing your income for the long term. You're just deferring it. So next year you're going to have less expenses, even if you prepay again, because this year you also were paying probably in monthly installments. So you're just deferring to when you're going to have to pay those taxes, which technically is good to always kind of push it back, but it works one time. Doesn't work every year.
Gotcha. Yeah. And that's just, yeah. But it's all there. What I want to just say there is you want to have a good foundation if you're going to have rental real estate.
Oh, absolutely.
Even if you only have like 3 properties, it's worth chatting with a bookkeeper, chatting with an accountant. Make sure you're chatting with me. Like reach out to me and say, hey, Dave, how I'm struggling. I have a really bad system. What's your system for, how you organize to make sure you're not stressed?
I like to think of the bookkeeping as kind of the recipe to how the profit is made. because if you don't necessarily know how to make a cake and I dump a pile of ingredients in front of you, you can kind of try to fumble through it, but it's not going to turn out good. And it's the same thing with your bookkeeping. You might have a general idea of what your income and expenses are, but it's a lot better if you have full clarity and understanding for you to grow this in the future.
Yeah, no doubt. No, I appreciate it. Hey, Colin, I appreciate you coming on and sharing your wealth of knowledge. If investors are looking for bookkeeping help and they want to reach out to you and your company, Windstone Financial, what's the best place? How do they reach out to you?
You go to our website, which will just be windstonefinancial.com. You could book a call with me directly on there, and we can chat for 30 minutes and just go over your business, your investments, and anything that you're struggling with and need help with.
Yeah. No, I love that. So yeah, for anybody that needs that help, definitely reach out to Colin. He didn't chat about this because it wasn't part of this call, but he also has a bunch of cool little dashboards that he can incorporate in your business to kind of help you track cash flow, to help you kind of plan for the end of the year. So I'll give you that plug that he has, and it's a bunch of unique dashboards that he's created within his company that are pretty cool.
We recently finished our live tax estimator app. It'll pull in all your data directly from QuickBooks. It'll give you your tax estimate and allow you to create custom scenarios with it as well to see how it changes your taxes. Super helpful for planning, because the first step of planning is just having an idea of what you're going to have to owe.
Yeah, love that. No, thanks so much, Colin, for sharing your knowledge. And again, if you guys have any questions or you think like, hey, me and Colin are, missing something here that's a huge tax saver that you're using, let us know. Like I said before, I can always be wrong. I'm always willing to be humbled of somebody saying, hey, I'm doing this and it's working really well. And for me to look at it and say, yeah, I need to use that in mine. So definitely share. That's what this community is so important with. So thank you guys so much. We'll see you in another show. I'll see you next time. Thank you, Colin. See ya.
Thanks for having me.